Welcome to Gurukul Live lecture series, and today I am going to cover up the topic of primary markets. As all of us understand, a very important component of financial markets of any economy includes financial instruments. Now these instruments include shares, bonds, stocks and other marketable securities. When these marketable securities are issued to the general public for the first time, that market is known as primary market. So today's focus of discussion would be on the primary market, how these shares, bonds and other stocks and marketable securities are issued, who can buy these stocks and bonds, and what are other terminologies related to it, and how SEBI regulations affect this particular market. So talking about these securities which are sold in the primary market, but the definition of securities as per Securities Contract Regulation Act 1956 includes instruments such as shares, bonds, stocks or other marketable securities of similar nature in or of any incorporate company or body corporate, government securities, derivative of securities, units of collective investment schemes, interest and rights in securities, securities script or any other instrument so declared by the central government. What is securities market? Securities market basically is a place where buyers and sellers of securities can enter into transactions to purchase and sell shares, bonds, debentures, etc. and other such securities. The securities market provide a channel for allocation of savings to those who have productive need for them, that is, transfer of those resources from those who have idle resources, who are investors, to those who have need for them, that is, corporates who need the money. Now there are various market regulators which are playing a role of regulating the securities market. So this responsibility is shared by Department of Economic Affairs, Department of Company Affairs, Reserve Bank of India and Securities and Exchange Board of India. So various regulators from time to time they come up with various regulations related to the market. Securities market can be classified into primary market and secondary market. Primary market is that market where first time any security is issued to the investor. Secondary market is the market where already existing securities are bought and sold again and again. Now talking about the market participants in this market, there are investors, intermediaries and issuers in this market. Now what is primary market? The primary market is that part of the capital market that deals with the issuance of new securities. It provides a channel for sale of new securities. New stocks and bond issues are sold to investors via a mechanism known as underwriting. Securities in the form of equity or debt can be issued in the domestic or international market at face value, discount or a premium. Features of primary market of any economy includes, it is also known as new issue market. In a primary issue, the securities are issued by the company directly to the investors. The company receives the money and issues new security certificates to these investors. Primary issues are used by companies for the purpose of setting up new businesses or for expanding or modernizing the existing businesses. What are the functions of primary market? There are three important functions of primary market. First function is organization. Organization refers to the work of investigation, analysis and processing of new project proposals. It deals with the origin of new issue, the size of issue, timing of issue and flotation method. So whenever a company is planning for issuing shares, it is coming up into the primary market. So they have to organize. They have to first see that what kind of proposal they are going to start with and what kind of investment that would require, and how much should be the size of that public issue which they want to launch so that money can flow into the company related to that, and at what time that issue should come, what should be the flotation method of that. After that they do the underwriting. Now underwriter is a banker or any agent of a financial institution who deals chiefly in selling and distribution of new securities to any investor. Underwriting is an agreement whereby the underwriter promises to subscribe to a specific number of shares, debentures or a specified amount of stock in the event of public not subscribing to the issue. After that, After the lead manager is appointed, the public issue is floated and the underwriting is done. After that happens the distribution. Now, it is the function of sale of shares and debentures to the investors. This is performed by brokers and agents who make a list for clients who purchase and sale of securities. So, for any company to issue shares for general public, they have to come up with a prospectus. Prospectus is a document which the company issues, which is an invitation for offer of shares to be sold, that anyone who wants to buy the shares of the company, they can read the prospectus and they can send the application money with the prospectus. As per section 270 of the Companies Act 2013, it defines prospectus as, prospectus means any document described or issued as a prospectus and includes any notices, circular, advertisement or other document inviting deposit from public or documents inviting offer from the public for subscription of shares or debentures in a company. A prospectus also includes shelf prospectus and a red herring prospectus. A prospectus is not merely an advertisement. Any document can be called as a prospectus if it is satisfying two things. It invites subscription to shares or debentures or invites deposits, and the aforesaid invitation is made to the public. What are the contents of a prospectus? Usually most of the companies will follow a standard format while preparing a prospectus, which is an invitation of offer for buying the shares of the company. It includes the address of the registered office of the company, name and address of the company secretary, auditor, bankers, underwriters, date of opening and closing of the issue, declaration about the issue of allotment letter, refund within the prescribed time, a statement by the board of directors about a separate bank account where all monies received out of shares issued are to be transferred, details about underwriting of the issue, consent of directors, auditors, bankers to the issue, the authority for the issue and details of the resolution passed thereof, procedure and time schedule for allotment of issue of securities, what is the capital structure of the company, what is the main object and present business of the company and its location, the main object of the public offer and the terms of the present public issue, minimum subscription period, amount payable by way of premium, issue of shares otherwise than on cash, details of directors including the appointment and remuneration of directors, disclosure about sources of promoters' contribution, particular relation to management perception of risk factors specific to the project, gestation period of the project, extent of progress made in the project, deadlines for completion of the project. Now, why there is a need for companies to issue shares to the public? Mostly companies usually are started by promoters who are privately who bring in the money and they start the business. However, when the requirement of the business increases, when the company increases in size, grows in size and more capital is required, so company can borrow money from banks and financial institutions. It may not be sufficient for setting up or running of the business over a long period of time. So, to maintain and the running of the business smoothly and to fulfill the extra requirement of funds, a company can think of issuing shares to general public or raising money through bonds or any other financial instrument from the general public. So, companies invite the public to contribute towards the equity and issue shares to individual investors. The way to invite share capital to the public is through a public issue. So, public issue means any issue of shares where general public is being invited for subscribing to the shares is a public issue. And when a company is issuing these shares for the first time, it is known as initial public offer. What are the benefits of a public issue? It enlarges and diversifies equity base of the company. It enables cheaper access to the capital. It increases exposure, prestige and public image, attracts and retains better management and employees through liquid equity participation. It facilitates acquisitions, potentially in return of share of stocks, create multiple financing opportunities, equity, convertible debt, cheaper bank loans, etc. There are various kinds of issues in the primary market. One such issue is known as public issue. Now, public issue can be initial public offer or further public offer or follow-on public offer. So, public issue means where public is invited to buy the shares. If these shares are issued by the company for the first time, it is known as IPO, initial public offering. And if it is an existing company who already has shares with the general public and wants to further issue shares to public, so it is known as further public offering or follow-on public offer. So, initial public offer or further public offering can be classified as or can be defined as it's a fresh issue or it is offer for sale. Another type of issue is right issue. Right issue is that public issue where the existing shareholders get the first right to buy the shares, and later on the new shareholders can also participate. Third type is preferential allotment or preferential issue. In preferential issue, the company is issuing shares to a specific set of people who they have already contacted them and already have talked about it, that we are going to issue shares to you, and they want to buy the shares of the company. The public issue or public offering refers to the issue of shares or convertible securities in the primary market by the company's promoters so as to attract new investors for subscription. In a public issue, the shares are offered for sale in order to raise capital from the general public, for which the company issues prospectus. The investors who want to subscribe for the shares make an application to the company, and then the company allots shares to them. What is an initial public offer? An initial public offer is the selling of securities to the public in the primary market. An initial public offering is simply an offering or flotation when a company called the issuer issues common stocks or shares to the public for the first time. It can be issued by a small young companies as well as by large privately owned companies. The sale of securities can either be through book building process or through normal public issue process. An IPO for an investor can be pretty risky. Further public offer. If an already listed company which has gone through an IPO offers new, or in better words additional shares to the public for sale so as to expand their equity base or pay off debts, it is known as follow-on public offer or further public offering. Then another type of issue is composite issue. Composite issue means an issue for specified securities by a listed issuer on public cum right basis, wherein the allotment in both public issue and the right issue is proposed to be made simultaneously. Next type of issue is private placement. So, private placement is if a company offers shares to selected group of investors, which can be mutual fund, banks, insurance company, pension funds and so forth, to raise capital. It is known as private placement. It can be further classified into three types: preferential issue, qualified institutional placement and institutional placement program, IPP. Preferential issue is preferential allotment is one in which publicly listed enterprises allots the shares to a selected group of investors such as individuals, venture capitalist companies on preferential basis. Second type is qualified institutional placement. If a listed company offers equity shares or non-convertible securities to qualified institutional buyers for sale to or raise capital, here the qualified institutional buyer includes mutual funds, venture capital funds, public financial institutions, insurance funds, scheduled commercial banks, pension funds, etc. Third type of preferential issue is institutional placement program. If a publicly listed company makes a follow-on offer of equity shares or the promoter offers shares for sale wherein the shares are allotted to qualified institutional buyers only with the aim of achieving minimum public shareholding, then it is known as institutional placement program. Another important term related to public issue is right issue. Right issue is when a company proposes to issue fresh shares to existing shareholders at a given price, which is usually at a discount, and they give a fixed time duration that within this time duration the existing shareholders are invited that if they want to buy the shares, they can buy it at a discount, and later on rest of the issue is available for general public to buy. A right issue is directly offered to all shareholders of record or through broker dealers of record and may be exercised in full or partially. Because the company receives shareholders' money in exchange for shares, a right issue is a source of capital. So, in return, the company is raising money, and that ways the benefit of right issue is that the ownership does not get diluted, because the existing shareholder, if he wants to maintain his percentage share in the company, he will buy more shares in the right issue. So, what are the benefits of right issue? Right issue provides existing shareholders with the option of purchasing shares at a discounted rate. Troubled companies typically use right issue to pay off their debts. This route is best suited for companies who would like to raise capital without diluting stake of their existing shareholders. But there are certain limitations of right issue. Value of each share will be diluted as a number of shares are increased. Investor can get tempted to buy shares at a discounted rate using right issue, but there is no certainty that whatever you bargained for will necessarily fetch you benefits. A right issue might be the solution to a troubled balance sheet, but right issue does not hold the answer to organizations delaying problems. Another type of issue is a bonus issue. Bonus issue is capitalization of free reserves. So, on the balance sheet of a company has got general reserve, or you can say reserves and surpluses after the equity capital it is given. It is accumulated profits which have been taken up for many years. It includes share premium amount. So, if a company has huge amount of free reserves, there are more chances that a company can come up with a bonus issue. So, what happens, in the balance sheet only that reserve amount gets converted into the equity capital. So, company convert their retained earnings into capital. It helps the company to boost the liquidity of stocks, and it brings down the stock prices, and it also helps the company to restructure the capital. So, whenever a IPO or a public issue, where we will be using these terms interchangeably, so the primary market is the one where shares are issued first time to the first investors. So, it can be in the form of a company issuing the shares for the first time. It can be in the form of a public issue where the company already is a listed company in the stock exchange and is further issuing the shares, or it can be in the form of a right issue or a bonus issue. So, the process is that there is an issuer, it sends the whole proposal and appoints an underwriter who will help the company to get the shares floated in the market, do the broking, and also will be the lead manager, and ultimately the shares go to the investors and the money flows from investors to the issuers. Talking about underwriting, which is an important part of the process of IPO, underwriting, the issue of shares of debentures is a contract between the company and another party called underwriter, whereby in the event of the shares or debentures not being subscribed fully by the public, the underwriter agrees to take up the balance. There are various types of contracts which an underwriter can take. Some common methods are discussed here, like best effort contract, firm commitment contract, all or none contract, self-distribution of stock contract. In the firm commitment contract, the underwriter guarantees the sale of issued stock at an agreed upon price. For the issuer, it is the safest but most expensive type of contract, since the underwriter takes the risk of sale. In the best effort contract, the underwriter agrees to sell as many shares as possible at an agreed upon price. Underwriter, under the all or none contract, which is the third type of contract, the underwriter agrees either to sell the entire offering or to cancel the deal. The fourth one is standby underwriting, also known as strict underwriting or old-fashioned underwriting. It is a form of stock insurance. The issuer contracts the underwriter for the later to purchase the share the issuer failed to sell under stockholder subscription and applications. Now, talking about the pricing of an IPO, what should be the price of a public issue when the company is issuing shares? That's a big question. So, any company who's issuing shares, first of all, the company would look at a process, would see that why does it need money. A company can need money for expansion, a company can need money to start a new project, a company can need money to invest money in some other proposal for expansion of the business. So whatever is the reason why the company needs money, the company first identifies that from where that money will come. Can it be taken out from the existing profits, from the existing reserves which are there? Can this money be borrowed from general public or from a bank or any other financial institution? Or if borrowings are already more and then the amount of requirement of money is huge, then the company can decide that okay, we would like to go for a public issue. And once the company decides for going up for a public issue, the company appoints a lead manager. Who is the lead manager? A lead manager is a person who is a merchant banker who is registered with SEBI, and it is compulsory for all public issues to have a merchant banker or a lead manager who is going to manage as an outsourced person. He is going to manage the public issue for the company. So he is the one who's directly in touch with the company and with consensus of the company is trying to help the company sail through the process of a public issue. So company and the lead managers, they together will form the prospectus and submit it to SEBI, to stock exchanges where the company wants to get listed, and to various other places where they are supposed to submit that prospectus. After that, an advertisement comes to us, where in the advertisement it is mentioned that what is the IPO size, how much shares the company wants to float in the market, who can buy these shares, and what is the price of the shares. So once the application process is complete, the company sees that how many applications have been received. Seeing the amount of applications they have received, they will decide that who will be allotted the shares. So the share allotment process is done. After the share allotment process, the company will again take up and go for will again come up with an advertisement saying that these people have been allotted share and rest of the people have been refunded the money, those who could not get any shares of the company. So like this whole process of public issue happens, and there are new shareholders who get registered with the company, who become a part of equity shareholders of the company, and the company in return raises huge amount of capital which they had proposed to raise in the prospectus, or when they were having that meeting that they want to raise capital. So they are able to accumulate that amount of money and they can use it for investment purposes. Now, talking about this whole process, there is one important component in this process, that is that what will be the pricing of that issue. How will it be decided that what will be the price of the share which is being issued to the general public in the market? Who will decide that price? So there's an initial price. All of us know that there's a face value of a share. Face value of a share, usually we see it is rupees 10. So it is written in the memorandum of association of the company that if the what is the face value? It can be rupee 1, it can be rupee 10 or rupee 100. So whatever is the face value, the price of the public issue, whenever it will be issued, it will be higher than the face value. Now there are two types of pricing what the company can do. One is known as fixed price issue, another one is known as book building process. So there's an initial price. A company that is planning for an IPO, they can appoint lead managers to help decide upon an appropriate price at which the shares will be issued. So price in a fixed price issue is fixed by the company with the help of its lead managers. Second type of issue pricing is book building process. Now this is a new method of pricing of a public issue. In case of book building process, the company is giving a range, is giving a price range where the company is defining that the shares can be issued. Within this, the shares are issued, and anybody who wants to buy the shares can give a bid for the price. So that means the investor is invited to inform about the bid of the price, about the bid. So the company will define the lower price range and the upper price range, within which any investor, based on his understanding, would fill up that what should be the price of this particular issue. So this process is known as book building. In this process, the company gets to know that what kind of price people perceive that is right for the company. So what should be the price of this particular equity share? If it is decided by the investor, maybe it will be more successful, that share will be more successful in the secondary market when it will be traded. So the process of issuing shares and deciding the price, where the price is in the hand of the investor to be decided, and the company waits and understand that what kind of prices company is the investor is offering, is known as a book building process. So it refers to the process of generating, capturing and recording investor demand for shares during an IPO in order to support efficient price discovery. Usually the issuer appoints a major investment bank to act as a major securities underwriter or a book runner. What is the difference between a fixed price issue and a book building issue? In a fixed price issue, first difference is about the price. Price at which the securities are offered, allotted, is known in advance to the investor, but in case of a book building process, it is just a price range which is defined, and the investor decides that what should be the price. The second factor where the difference lies is in demand. So demand for securities offered is known only after the close of the issue. In a book building process, every day you get to know that how much people are offering, are buying, and what kind of prices they are offering. And third difference is in the payment. In the book building process, payment is made only after the allocation, and in case of fixed price issue, payment is made at the time when subscription, wherein refund is given after the allocation. The book building issue. In the book building issue, it is the price which is decided by the investor. In a fixed price issue, the price is decided by the company. Nowadays, all companies, it is compulsory for them to follow the book building issue. So in a book building issue, the issuer company mentions the minimum and the maximum price band at which it will sell or issue its shares. Thus, the offer document, which is known as a red herring prospectus, contains only the price band nowadays, instead of the price at which the shares are offered to the public. Within this price band, the investor can choose the price at which the investor are willing to buy the shares and also the quantity they want to buy. As this process is similar to the bidding in an auction, the application form for the book built issue is also known as bid form. At times, the issuer may revise the price band, which has to be accompanied with a newspaper advertisement. SEBI guidelines define book building as a process undertaken by which a demand for securities proposed to be issued by a body corporate is elicited and built up, and the price for such securities is assessed for the determination of the quantum of such securities to be issued by means of notice, circular, advertisement, document or information memoranda or offer document. Book building is basically a process used in IPO for efficient price discovery. As per SEBI guidelines, an issuer company can issue securities to the public through prospectus in the following manner. It can come up with 100% of the net offer to the public through book building process, 75% of the net offer to the public through book building process, and rest of the 25% can be done at a price determined through the book building. The fixed price portion is conducted like a normal public issue after the book building portion, during which the issue price is determined. The concept of book building is rather relatively new in India, but it is very common in developed countries. Bids by various investors are entered into the stock exchange system through the broker, also known as syndicate or terminal member. The list of this bid received from investor at a various price band is known as a book, and it can be seen on the website of the stock exchange for each investor category. In book building, the demand can be known every day as the book is being built. Based on the total demand in the book, the cut-off price is then decided by the issuer and the merchant banker. The actual discovered issue price can be any price in the price band or any price which is above the floor price. The issue price is known as the cut-off price. The floor price is the minimum price at which the bids can be made. The prospectus may contain either the floor price for the securities or a price band within which the investor can bid. The spread between the floor and the cap price band shall not be more than 20%. That is, the cap should not be more than 120% of the floor price. Now, it is up to the company to decide the price band in consultation with the merchant bankers. The book should remain open for a minimum of 3 days, and only electronically linked transparent facility is allowed to be used in case of book building. It takes 12 days for the closure of the book built issue. The process of allotment is completed within 15 days from close of the issue, and after that, within 2 days, money and shares are credited to the account of investors. The registrar to the issue then finalizes the list of eligible allottees after deleting invalid applications and ensure that corporate action of dispatch of shares to the demat account and refund process is carried out. The lead manager coordinates with him in this process. The shares get listed after 3 weeks of closure of book building issue. What are the benefits of book building process? Book building process enables issuers to reap benefits arising from price and demand discovery. The cost and time for making public issue is covered. The procedures are simplified. The possibility of price falling below the par after listing is remote. Another concept is reverse book building. The reverse book building is a mechanism provided for capturing the sell orders on online basis from the shareholders through respective book running lead managers, which can be used by companies intending to delist its shares through the buyback process. So, when a company wants to buy back its shares from general public back to the company, this is known as buyback, and nowadays for this buyback process, reverse book building is followed. That means again the company will give a price band, and within that price band people have to define that at what price they are ready to sell the shares back to the company. So, in the reverse book building scenario, the acquirer company offers to buy back from the shareholders, and it is again for the efficient price discovery. It is a mechanism where during the period from which reverse book building is open, offers are collected from the shareholders at various prices, which are above or equal to the floor price. The buyback price is determined only after the offer closing date. Business process for delisting through book building is as follows. Now, sometimes there are companies who are buying back the shares because they want to delist from the stock exchange. So, the acquirer shall appoint designated book running lead managers for accepting offers from the shareholders. The company acquirer intending to delist its shares through book building process is identified by way of symbols assigned to its BRLM. Orders for the offer of sale shall be placed by the shareholders only through the designated trading members duly approved by the exchange. The designated trading members shall ensure that the securities shareholders deposit the securities offered with the trading member prior to the placement of an order. The offer shall be open for n number of days. The BRLM shall intimate the final acceptance price and provide valid accepted order file to the National Securities Clearing Corporation Limited, which is a wholly owned subsidiary of NSE for carrying out the clearing and settlement operations. Promoters of the companies who voluntarily seek to delist their securities from all or some of the stock exchanges, cases where the person in control of the management is seeking to consolidate his holdings in the company in a manner that it would result in public shareholding or in the listing agreement that may have an effect of the company getting delisted. SEBI guidelines shall be applicable to delisting of securities for companies and specifically applicable to voluntary delisting being sought by the promoters of the company, any acquisition of shares of the company either by the promoter or by any other person or scheme or arrangement by whatever name it is referred to, consequent to which the public shareholding falls below the minimum limit specified in the listing conditions or listing agreement that may result in delisting of securities. Promoters of companies who voluntarily seek to delist their securities from all or some of the stock exchanges. Cases where the person in control of the management is seeking to consolidate his holdings in the company in a manner which would result in public shareholding or in the listing agreement that may have the effect of company being delisted. Companies which may be compulsorily delisted by stock exchange, companies which may be compulsorily delisted. So that's how the reverse book building process is followed for the buyback of shares by the company. Another important concept and term which every day we listen to when we are talking about a public issue is application supported by blocked amount, ESBA procedure. ESBA basically is a very good initiative of the financial market, where earlier what used to happen, that when people were filling in the application amount, they were sending the money through the check that we want to buy these shares, and they used to send their application from the application form given in the prospectus along with the requisite amount of money in the form of a check to the company, and the company used to allot the shares. After the allotment was done, there were people who were getting the shares allotted, so their money would be kept by the company, and there were other set of people, investors, who were not allotted any shares because of oversubscription, and they were told that money will be refunded to you, and the company used to send the checks back to them, or used to give them refund after few days of time. And this was a cumbersome process of investing money, and sometimes the check can get lost, sometimes the check can get soiled or misplaced. So that way there were a lot of difficulties. So when everything has become electronic, like you have a demat account through which you can apply for an IPO, you need not send a hard copy application for the IPO. So if that process was electronic, so this ESBA scheme is a scheme through which you have a bank account which is associated with your demat account, so money will be blocked in that bank account for the amount of money for which you have invested in the shares, or you have applied for the shares. If the shares will be allotted to you, that money will be transferred to the company from your bank account directly, and if those shares are not allotted to you, that block, so it is an amount is just blocked in your account. It is not transferred from your account to the company. It will be transferred from your account to the company's account till when you will be allotted the shares. But if the shares are not allotted to you, just that block will be removed. And this procedure has made the things a lot simpler, the faith of investors has increased, the money related problems have reduced in companies, and so ESBA is a very effective way of dealing with money in the process of allotment of shares. But during rest of the period, till the time that application process and the allotment process is complete, the money which is blocked, you cannot use that amount because it is blocked. So ESBA provides an alternative mode of payments and issue, whereby the application money remains in investor account till finalization of basis of allotment in the issue. ESBA process facilitates investors bidding with multiple options to apply through self-certified syndicate banks, in which the investors have bank account. These self-certified syndicate banks are those banks which satisfy the conditions laid by SEBI. The SCSBs would accept the applications, verify the application, block the fund to the extent of the bid payment amount, upload the details in the web-based bidding system of NSE, unblock once the allotment is finalized, and transfer the amount of allotted shares to the issuer. Now, this method would coexist with the current procedure of investors applying through sub-syndicate, syndicate members with check as a payment instrument. Who are the participants in the primary market? So, there are various participants in the primary market, which includes merchant bankers. Merchant bankers have a very important role to play in this market because they are the one who are facilitators, who are consultants, who are outsourced agents of the company, who are helping the company to deal this whole mechanism and process of public issue. So these merchant bankers get involved with the company as soon as the company thinks of coming up with the public issue. So they help the company at every stage, and their work will end when the company has already allotted the share and the shares are listed in the stock exchange. Second important member is registrar to the issue. Registrar to the issue maintains the documents and the listing of shares and the listing of registered members or equity shareholders is done with the registrar to the issue. Bankers to the issue are those parties, those banks where the amount of money will be deposited for the public issue, who will be of those people who will be investing in the market. There are agents and brokers, so there are depository participants, there are brokerage companies who are acting as broker of the company for the public issue. Then there are auditors of the company who certify the whole process of prospectus being issued, and who certify rest of the things which happen during the public issue. Then there are syndicate members who are underwriters, so they can be team of underwriters when the underwriting of shares is done. Now, what is underwriting? Underwriting basically is that if the company does not fulfill the minimum subscription norm. What is this minimum subscription norm? This minimum subscription norm of the public issue is that whatever is the size of public issue, if a company is not able to get 90% of its public issue subscribed by the investors, then the company is not allowed to complete that issue, and it has to return everybody's money back. So, for that purpose, to secure that 90% minimum subscription criteria, companies, they take help of underwriters who give a guarantee that if other people will not buy the shares of the company, they are going to buy the shares, and later on they will sell the shares to the general public, so that once that minimum subscription criteria is fulfilled. Now, since a public issue of companies is so huge, it's not expected that there will be one underwriter who will be giving a guarantee for the whole public issue. So, there can be a syndicate of members, a group of underwriters who come together, who join hands and who participate and who help the company give this guarantee that they are coming with the public issue. Now, there are some regulatory measures by SEBI for primary market as per the latest regulation of 2018 in the issue of shares by companies. So, company has to make compulsory disclosure of all material facts. SEBI has made it compulsory for companies to disclose all the facts and risk factors regarding the projects undertaken by the company. Also, the basis on which the premium amount is calculated should also be disclosed by the company. Encouragement to initial public offers. SEBI has permitted companies to determine the par value of shares issued by them to encourage initial public offers in the primary market. SEBI has allowed issue of IPOs to go for book building process, that is, reserve and allot shares to individual investors, but the issuer will have to disclose the price and the issue size and the number of securities to be offered to the public. Increase in popularity to private placement market. SEBI is encouraging the private placement market. Private placement market has become popular with issuers because of stringent entry and disclosure norms for public issue in recent years. Besides low cost of issuance, ease of structuring investments and savings of time, lag in issuance are other causes responsible for rapid growth of private placement market. Optional underwriting of issue is allowed. So, SEBI has made underwriting of issue optional to reduce the cost of issue in primary market. However, the condition that if an issue was not underwritten and was not able to collect 90% of the amount offered to the public, the entire amount collected will be refunded to the investor is still in force. That means if you are short that your share will be fully subscribed, you are a very popular company, then maybe you can avoid the underwriting thing. Issue of due diligence certificate has been asked. Due diligence certificate has now been made a part of the offer document, which will be issued by the lead managers. Conditions regarding application size. SEBI has raised the minimum application size and also the proportion of each issue allowed for firm allotment to institutions such as mutual funds. Regulation of merchant banking. SEBI has brought merchant banking under its regulatory framework. Merchant bankers now have a greater degree of accountability in the offer document and in the issue process. Imposition of compulsory deposit on companies making public issue. SEBI has advised stock exchanges to collect from companies making public issue a deposit of 1% of the issue amount, which could be forfeited in case of non-compliance of provisions of listing agreement, and non-dispatch of refund orders and share certificates by registered post within the prescribed time limit. This has been done to induce companies to exercise greater care and diligence for timely action in matters relating to public issue of capital. The government has allowed setting up of private mutual funds. Government has now permitted the setting up of private mutual funds. UTI has not been brought under the regulatory jurisdiction of SEBI. All mutual funds are allowed to apply for firm allotment in public issues as well as underwrite public issues. Further, SEBI has relaxed the guidelines for investment in money market instrument and has also issued fresh guidelines for advertising by mutual funds. SEBI vets the offer document to make sure that the company listing the shares has made all disclosures in it. All the guidelines and regulatory measures of capital issues are meant to promote healthy and efficient functioning of the issue of the primary market. SEBI has also come out with major policies that they want to implement in 2018-19 to enhance the overall functioning of markets and companies. These include plans like enhanced surveillance on the equities market to safeguard investors through analytical and statistical tools for better scrutiny, SEBI to use new technologies like blockchain and artificial intelligence, machine learning to be deployed to handle challenges arising out of technological advancement in the market. SEBI will also be implementing policies in the primary market, commodities segment and mutual fund sector. SEBI strengthens rules and regulation on insider trading. It is trying to reduce uncertainty in the market, disincentivize misuse of price sensitive information being shared by insiders of listed companies, formalize an arrangement or memorandum of understanding with enforcement agencies to make it easier to share critical information between regulators and enforcement agencies. Client activity will also be monitored by the registered intermediaries as said by SEBI. SEBI also plans to reduce the listing time of public issue for primary market. For secondary market, the regulator is planning to implement a framework for interoperability between clearing corporations. More products are likely to be allowed in the market as options for investors. To review the norms surrounding stress testing, risk management and settlement guarantee funds. Integration of commodity, spot and derivative market will take place in a phased manner. There are a lot of recent initial public offers that has come, and the list is available, and we can just have a look at the kind of public issues or recent IPOs which have been launched. So these were launched in 2019 very recently, and the offer price at which these shares were offered to the general public is also given in this in this chart. So these are some of the recent IPOs which have come up. Now, talking about the top performers IPO. So this list shows some of the top performer IPOs with their IPO price, listing returns, 1 week returns after getting listed, 4 week returns after getting listed and 6 week returns after getting listed. Now, talking about the whole industry data, in year 2017, the maximum resources have been mobilized from the insurance sector and followed by the finance and the healthcare sector. So these are the main industries in 2017 which came up with an IPO. Looking at another graph, we can see here that how much resources were mobilized from the primary market in April to December 2017. So if you can see on this graph, the various instruments are shown here like bonds, equity at premium, IPOs, listed, right issue, public issue. So these are shown here, and it has been seen that least amount of money was mobilized from bonds and right issue, and equities were issued at a very high premium and public issues were maximum in the year 2017. Sector-wise distribution of resources mobilized in 2017 includes that, shows that private sector had more number of IPOs coming up as compared to public sector IPOs which were launched. How much resources were mobilized in the primary market through public issue and right issue? This data is from April 2010 to April 2017, and we can see here this blue graph which shows that public issues were much more popular as compared to right issues, but in April 2015 the amount of right issues were higher than the public issues. Amount of resources mobilized from the primary market in terms of companies who were already existing, they came up with a public issue or a new IPO had come. So, this blue line of graph shows that the listed company IPOs which were very high during from April 2010 to April 2017, but the IPOs were significantly popular in April 2017 as well as April 2000 after between 2010 and 11. And talking about how much resources were mobilized through equities and the bond market, we could see that the equity market has shown better results in 2017 as well as in 2010 and 11. Which are the world's largest IPOs that we have seen in all over? So, the largest IPO which came was Alibaba Group in 2014, which was $25 billion IPO. Latest IPO was 2018 done by SoftBank Group, which was 23.5 billion, and then Agricultural Bank of China was the third largest IPO. Industrial and Commercial Bank of China was $21 billion, and American International Assurance was $20.5 billion. So, talking about all this scenario of primary market, so investing in primary market has become very easy nowadays, and people can very easily subscribe to IPOs and public issues. That's all for today. For any queries, you are most welcome to contact.